Lots of love flowing around for the euro, and reports that finance ministers have now reached a deal on Greece, and it only took them 9 hours, and now they can break for breakfast. Dow Jones citing EU officials saying the private creditors agreed to a bigger haircut of 53.5%. Bitter medicine. Maybe a teaspoon of sugar will help the medicine go down. Johanna Chua is Chief Economist for the Asia Pacific at Citi and joins us live, me and Adam, from our Hong Kong studios here. Hello, Johanna.
Hi, good morning.
We can rejoice. Break out
Finally.
the punch bowl. Greece is saved. The Eurozone is saved. I jest, of course.
Right.
So is this a big deal or really
Well, look, the market was already expecting for this to happen.
Yeah.
So if it didn't happen, it would have been a disaster for the market. So I think you do get a relief that it's come through, and at least we have enough support there for Greece to avoid a disorderly default on March 20th when the debt repayment happens. But I still think you're going to get coercive restructuring going on in March 20th.
Right.
And well, this is coming right before the LTRO, so it's obviously been positive for his sentiment.
All right, you said it. We now presumably we can afford a disorderly default on March 20th.
Avoid, yes.
So are they aiming for an orderly default further down the line? Is that the other flip side of the coin?
Well, you have to restructure the debt, right? So inevitably, these will involve haircuts. And because it's going to be coercive in nature, obviously this will trigger some CDS. Essentially, that's what has to happen for the debt to be brought down to sustainable levels. So, this is obviously a positive thing for the market, but, I think there's still a lot of risks we need to still watch out for going forward.
Yep. Adam, I kind of wonder if Greece is still still has an order disorder.
Yeah, that remains to be seen. I think we'll have to wait for a few years to see whether we're able to meet all those targets. Joanna, one of the risks out there flagged by what was happening over in Europe was the knock-on effect with China and their trade cycle. Now that we have this definitive agreement, is China out of the firing line now in terms of concerns about its economy?
Well, of course, Europe is still China's largest trading partner. So obviously, there's still an impact to what extent, how deep the recession in Europe is going to be and how that's going to impact China's economy. But, at the moment, the focus of China's economy and economic slowdown has really been more about concern about domestic demand and the slowdown of property investment. So, I think the news over the weekend of that reserve requirement cut is obviously a positive relief. We need to see more policy loosening going forward to restore further confidence in sort of a resilient growth.
But why aren't the investors in China buying that? I mean, we've already got twice the government cutting the RRR ratios for some of these banks. Now we've got this deal with Greece moving forward at least. And yet stocks in Shanghai continue to sort of dwindle at the 2,300 level.
No, I agree. I think it has been. The price action has been disappointing. When you look at the first reserve requirement cut last year, that was happening at a time when you had a lot of capital outflow out of China. So essentially what PBOC was doing was just kind of neutralizing the impact of the capital outflow. So it wasn't really seen as a liquidity injection policy easing. It's like a neutralizing impact. And then the second reserve requirement cut, it came later than people expected. And we are already a pretty tight liquidity situation happening in China, where some of the tightness on the open market operations was already happening. So this reserve requirement cut was seen as sort of helping offset that, and it came a little bit late. So we probably need to see more policy action, more visible policy easing. I guess the market demands a little bit more, proactive stance.
Yeah, I don't want to belittle the finance ministers and all their hard work tonight, trying to find this second fix for Greece. But as far as that situation goes, the only thing that we care about in Asia is that they, agree on something and that there is some sort of progress and things just don't bog down permanently. Here in these parts, now that we can, the euro is up, looks like the euro is saved for now, and Greece has bought itself more time. The PMIs have been surprising in Asia, right? They have, we've seen repeats of much less disappointing than expected numbers. I'm kind of wondering if the whole manufacturing mechanism maybe sort of bottoms out.
Right.
In the first quarter. People say that, even with a Greek solution, that doesn't mean that they're going to be piling, largely into European assets. It just means that they feel more confident about coming to where growth is in Asia. Do you think we're going to see a sudden spurt, a sudden, sudden surge of interest in liquidity?
I think it's definitely clear that we're seeing a bottoming of manufacturing cycle. I mean, people had destocked inventory quite a bit in the third quarter last year, in the middle of last year. So with U.S. growth not being that bad, it seems like, and even European data so far not being as bad as expected. And EM is still doing quite well with this liquidity injection. Yes, I mean, I think there is still some support for further recovery. But the question is, how much do we recover? So again, I think Europe has very, very difficult economic conditions. We're still going to go through recession. U.S. had a very, very strong, pretty sharp rebound in the fourth quarter. It will still be okay in the first quarter, but we'll probably see some tapering off of economic activity. Now for Asia, unfortunately, there's a lot of this Chinese New Year effect. So we had very strong December data. In January, we had very mixed data, kind of weak actually. But we don't know if the weakness in January is a function of Chinese New Year, because we had less working days. Right. So we probably need to see more data in February, so the January, February data combined to get a clearer picture. So my sense is I think growth is still okay. It just probably won't recover as sharply. It won't be a very, very sharp V-shaped recovery, and given the headwinds on China and also the headwinds on Europe.
Another thing just crossed the tape here, which I find kind of interesting, Adam. Because it's not, they haven't just negotiated the terms, the percentages, and the debt abatement on the, bailout package 2 for Greece, but now we're hearing, crossing the tape from officials quoted by Dow Jones, that the rate on the original bailout loans are going to be cut as well. They seem to be, it seems to be a giant love fest of generosity going on in Brussels over there.
I think they had to, because the last debt sustainability analysis in Greece showed that they could bring their debt from 160 to 129. And the target was they needed to bring it down to closer to 120. So I think this concession on the interest cost is a way they can make it still more favorable to improve the debt dynamics of Greece. But the challenge here is all this debt sustainability analysis makes certain macro assumptions that could be too optimistic. I mean, Greek economy last quarter, in the fourth quarter last year, contracted 7%. So if they continue to be in very, very deep economic downturn, they will still miss. I mean, the ability to meet these debt targets will still be very difficult despite significant austerity. So I think there's still a risk of slippage there.
Johanna, an interesting point here is now there's a lot of optimism across these risky asset classes that this deal is more or less being done. I'm wondering in terms of the implications across some of the asset markets, most notably some of the commodity plays, and how that might complicate the recovery and maybe hobble or paralyze the economic growth within many countries, not just in Europe, but also out here in Asia, because oil prices are fairly elevated. We've got Brent at 120 and NYMEX at 104, 105 levels.
No, that's a very good point, and that's a very big concern, because the geopolitical situation is still very unsettling. And if oil prices continue to rise sharply, obviously in an environment where Europe is already in recession, that could create negative implications for Asia. As you know, except for Malaysia and Indonesia to a certain extent, everyone is a commodity importer. So the terms of trade will negatively impact growth in this region.
Okay.